Dear audience, welcome to this episode of Financial News and Event Commentary. The Trump administration announced on January 12th that it would impose an additional 25% tariff on countries with trade ties to Iran. This move has once again pushed the uncertainty of global trade policies to the forefront. Drawing on the intensive analyses released by multiple institutions recently, we can predict the potential impact on the U.S. stock market from several key dimensions. First of all, the market reaction may be blunted, but risks are accumulating. Looking back 6 months ago, although policies such as the Beautiful Country Act led to higher-than-expected fiscal deficits, the market did not experience the drastic crash of stocks, bonds, and exchange rates that occurred in April and May 2025. Multiple reports indicate that the market's narrative regarding the impact on broad national credit has been blunted, with the focus shifting temporarily. However, Howard Marks of Oaktree Capital warns that the current period represents the biggest environmental shift he has seen in his career, and the predictability of the future is extremely low. This uncertainty itself is the greatest risk. Second, stagflation trade may become the dominant logic. The new tariff policy directly raises import costs. Combined with various tariffs implemented previously, its impact may start to pass through to consumer prices in the third quarter of this year. Historical experience shows that the tariff pass-through rate is usually high. This means that U.S. inflation may face the pressure of a summer rebound. At the same time, tariff and immigration policies are suppressing economic activities. This combination of slowing economic growth plus rising inflation pressure may push the market into a stagflation trade mode, putting pressure on high-valued growth stocks, especially technology stocks. Third, the attractiveness of U.S. dollar assets is facing long-term challenges. The tariff war has intensified concerns over the restructuring of global supply chains and de-dollarization. Data shows that the U.S. dollar index has fallen by more than 10% since peaking in January 2025. With most of the decline occurring after Trump announced the reciprocal tariffs in April. The unusual combination of rising interest rates and falling currency in the U.S. reflects the deepening doubts of investors about the reliability of U.S. dollar assets. International capital is actively seeking asset reallocation, with part of it flowing to markets such as Europe and the Asia-Pacific region. Finally, investment strategies need to shift towards defensiveness and anti-fragility. Against the backdrop of high macro uncertainty, institutional recommendations tend to be cautious. First, reduce overall exposure to U.S. stocks and increase holdings of safe haven assets such as cash and gold. Second, in terms of sector allocation, tilt towards defensive sectors with rigid demand such as consumer staples and healthcare, and avoid global trade-sensitive sectors like technology hardware and the automotive industry chain. Third, use market volatility, VX tools for hedging. Institutions including DBS Bank have clearly pointed out that building a resilient, globally diversified investment portfolio is the key to coping with the current changes. In summary, the tariff escalation on Iran-related countries is an extension of Trump's trade weaponization strategy. In the short term, U.S. stocks will face the triple challenges of downward revisions to corporate earnings, compressed valuations, and increased volatility. In the medium to long term, the fading of the American exceptionalism aura and the fragmentation of global trade may systematically raise the risk premium. The top priority for investors at present may not be chasing trends, but rather observing, comparing, and calmly assessing whether risks match prices amid uncertainty. That wraps up this episode. The market changes rapidly, so please refer to the latest information. See you next time.